Welcome back to the Indianpreneurship Workshop. In this session, we're going to be looking at the cash flow budget. In previous sessions, we've looked at the cash flow projections and the importance of cash flow projections, and in future sessions, we'll be looking at how you develop assumptions that you can enter into the cash flow budget. But for this session, I want to quickly go through the cash flow budget, how it looks, where you enter different types of data, and how it mathematically computes that data. So if you want to look in your Indianpreneurship workbook, the cash flow budget is located in Chapter 8, page 199. So let's get into the cash flow budget. One point I would like to talk about up front is the cash flow budget that you're looking at on the screen is not the one that's in your book. It's very similar. I didn't like how the workbook added different sections together. I thought it was a little bit confusing, so I redid the cash flow budget and renamed some of those different sections so they would be easier to understand. A copy of this cash flow budget is in the resource CD that has come with your Indianpreneurship workbook. So with that, let's get into the cash flow budget. Very basic information up here at the top with your business name and the owner or owners. And then there's going to be several sections here in the cash flow budget. First is A, cash on hand. B is cash receipts, that's money into the business. D is expenses, and this whole section here, as you can see in row 14, is cash out. There'll also be other operating costs, and then you'll have a total cash out and an ending balance. One thing I should say up front about the cash flow budget and cash flow projections in general. These are a little bit different than if you were to do a profit and loss projection, if you're familiar with that. What we're doing with the cash flow budget is we're showing when cash comes in and out of our business. So if you were to go buy some items either on a credit card or to go buy something on a loan, you would only recognize those expenses in the cash flow budget as you make those payments. So if you bought, let's say, furniture for your office but didn't pay for a year, you would not recognize that cash has left your business for 1 year, even though you've bought that furniture now. And the same thing happens when you earn money. If you are doing services on invoice, and so you are doing services and then you bill your customers, if those customers don't pay initially, then you will not recognize the cash flow in the current month. And if that customer doesn't pay for 6 months, even though you have technically done the work now, you'll actually only recognize that cash coming into your business 6 months later. So that's one thing that is a little bit different than profit and loss projections. The way the cash flow budget is laid out, you'll see under B here, column B, is a startup column. And this startup is the before your business starts. And one of the things that we did at the end of Chapter 7 is look at a startup budget. So that information that you have developed in the startup budget can be entered here under the startup column down here in D, expenses. So we're not having you do things unnecessarily. These are all important things that go in to helping you build your business plan. So let's take a look at how the cash flow budget works. And what I'm going to do here, because as I get down, we're going to lose which columns are which, so I'm just going to come up here and freeze this top row. And so we'll know, even though we can't see start, that it is startup is the first column here. And as we go down, let me see if I can get that. That's perfect. Okay, so as we go down here, the first section is A, cash on hand. So cash on hand is what you'll begin with right now. You may not have any cash on hand. If that is the case, you would enter 0 in here. And I'll just do that right now. And so since this is a spreadsheet and this is comes on your resource CD, this is fully typable, and we'll also provide this in Google Sheets in case you don't have Microsoft Excel. Google Sheets is free of charge, and if you have access to the internet, you'll be able to use this exact same cash flow budget in Google Sheets. So I'm just putting cash on hand at 0. So because this is the startup column, this is before your business starts, so you won't have any cash receipts. So all this can be left blank. Down here in expenses are, like I said previously, where the startup budget items will go. So if there are expenses that you have to pay for, office expenses, rent, advertising, utilities, insurance, anything, those are going to go right here. But remember, these are expenses that you're paying as you pay them. So if you go and get a $2,000 insurance policy that is going to be paid only $200 or so per month, you're not going to record in the first column here under startup that you have $2,000 in insurance expenses. It would only be as you make those payments. So maybe you've only paid now $200 to start the policy. That's what you would record in the startup column. And as we come down here, also in startup column, we have other operating costs. Now there may be other operating costs in your business. If you've already taken out a loan and you have to start paying back that loan now, or if you make a big capital purchase. And a capital purchase, the reason why we don't have that up above is there are some items that aren't expenses immediately. What happens is you only record them as an expense as you depreciate them. We don't want to get into all those technicalities because it can get very complex, and I don't want to bore you with all the specifics of accounting and tax law, but that's what we have capital purchases down there under other operating costs. And those are going to be for big items, such as a car, things like that. And so, like if you were to purchase a car and you go and make a down payment, and let's say the down payment is $1,000, that $1,000 would go there under, if you did it in the startup before the business opens, it would go in the startup column. And then as you make your monthly payments, those monthly payments would then go in the appropriate month, reducing cash flow each month. Okay, so we have total cash out. Oh, and I should say one other thing, that there could be some cash receipts if you actually go and get a loan, or if you have an investor that invests into your business and gives you cash that you're going to use into the business. Those are things that will that could be up there in cash receipts, even though you haven't opened the business yet. So just so we have clarity. So here's essentially how this is going to work. You start with cash on hand at the beginning of every month. Then you make sales. Some of this, if you have a cash business that's 100% a cash or credit card, essentially what I mean by that is you don't bill anybody for them to pay later. Then 100% of your sales are going to be received in cash receipts, number one, cash sales. So even though it's on a credit card, it's still technically a cash sale for the cash flow budget. If you do bill your customers, you're going to receive, you're going to enter here under number 2, accounts receivable, the amount that you have received from the customer that month. So let's say you're a contractor and you go and build a deck for somebody, and initially they pay you $500. Let's say the deck is going to cost $1,000, and they pay you $500 to start work. So in the first month, you may record $500. And let's say next month, because you've done a little more work, they pay you an additional $250. And then the following month, when the work is completed, they pay you the final $250. So there's your $1,000. But as you can see, you've received the $1,000 at different times. You've received $500 in the first month, $250 the second month, $250 the third month. And that's how that should be received, as opposed to saying, I earned $1,000 in the first month, or I earned $1,000 in the third month. It's actually when that cash comes into the business. So that's when you would enter things into accounts receivable. When you have items that you have sent out and you have done work on invoice, and when those invoices finally get paid, that's when the accounts receivable row would come into play. Investment would be invested into your company, and the loan proceeds would be if you go and get a loan, then when that loan proceeds, so essentially you go and get the loan, they give you, let's say, $5,000 loan, you would immediately receive that $5,000 into the business, and as you spend items from that $5,000, those would be down here in expenses, and then as you make payments, those would be down in other operating costs, loan principal payments. And then also with a loan, you'll have interest. The interest is an expense, and so you'd put the interest portion up here and the loan principal payments down here. So let me just kind of give you a rough kind of rough outline of how this startup, this cash flow budget will work by entering numbers. I'm just going to make some estimations and talk it out with you as I go along here. So let's say I start with cash on hand, and I'll just put it here in the startup section, because I have lots of these different rows have calculations in them, and this just makes it easier so you don't have to pull out the calculator. Microsoft Excel or Google Sheets will do the work for you. So I start with the cash on hand. Let's say I don't buy anything in the startup column, and I come down here and it's my first month, and I have $2,000 worth of sales. $1,000 is on accounts receivable. $1,000 is cash or credit card. So as you can see, 1,000 of that of those dollars I'm not going to receive this month. So I'm only going to put, even though I have $2,000 in sales, I'm only going to put $1,000 because that's the actual cash I received, and I'll leave accounts receivable blank. I didn't get any investments, and I didn't get any loan proceeds. As you come down here, let's say that I have a telephone, $50, and I bought some office expenses, and that cost $250, and I pay my car insurance, and that's $100, and we do, let's say, $200 in electricity, and I have a liability insurance policy that runs me $75. Okay, so I have some expenses that I've paid cash for in this first period, and what the cash flow budget will do, we'll add those up, so that's $675 in expenses. And if we come to the top here, you'll see we started with 1,000 because we started in the first column in the startup with 1,000, and we didn't have any expenses or income or any other cash receipts in the first column. So what happens is at the bottom you'll have 1,000, and you bring that to the top. So the first month also starts with 1,000 because we didn't have 0, and then at the bottom it started with 1,000, the ending balance. So that ending balance we bring to start the next month. So there is $1,000. So we had $1,000 in cash sales. So we had a total cash receipts, because this total cash receipts adds up these four items here. So that's 1,000. And then we add our cash on hand to what our cash receipts are for total cash available. Then we take a look at our different expenses, and we add all our expenses. We also look at other operating costs, and we'll assume now that I don't have any, and we'll add this $675 plus 0 for this total cash out of $675, and then we subtract $675 from this $2,000 here, and then that leaves us with an ending balance of $1,325. And if you remember, the ending balance from the previous month starts as the starting balance for the following month. So we take this $1,325 and we move it up here to cash on hand to start the second month. And then we will go through this as we run through the entire cash flow budget. We may have another 1,000 in cash sales, but some of those people from the previous month have paid their invoice. Let's say we receive $500 of payments. And one thing I will say to make it easier in the cash flow budget, because as you get further and further out, you are making estimations of income and expenses, and it gets to be hard. And in this next session that we talk about, we'll take a look at building those assumptions. But when you actually have this in front of you, one nice thing that makes it easy to do is to take expenses that you have currently and to assume that those expenses will generally be the same throughout the entire year. And what I mean by that is, so let's say you have a cell phone, and that's going to be your main telephone for your business, and you currently pay $50 for that cell phone each month. Well, it's most likely going to continue at $50. It may be $47 some months, certain taxes and different things. Maybe you called 411, and I know some places charge for 411, so some months it's $52, but it's always going to be around the $50 mark. So to make it easy on you in projecting at least the telephone throughout the entire year is to just take this $50, and I'm just going to copy it. You can also enter it manually. And I'm just going to take it across for the entire year and hit paste, and there you go. You have $50 in each telephone column. And so what that does is that makes it easy for you to begin to think about, okay, what expenses am I going to have each month? And what I've tried to do here in the cash flow budget is to give suggestions of typical expenses. And even down here, you'll see 18, 19, 20, 21, 22 are left blank, because in each person's business there are unique categories that I can anticipate and use those areas. And this is an Excel spreadsheet, and so you could add as many as you want. So if there are even more categories that you would like to add, or if you want to get even more specific on some of the categories up here or anywhere on the sheet, feel free to add those. And if you need help with the calculations behind the scene and how to add certain columns, I'm more than happy to help with that. But telephone is a good one to take all the way across. If you have insurance, like a liability policy, that's probably going to be the same every single month. Utilities will change depending on seasons. Generally, you'll have higher gas or electricity bills depending whether it's summer, fall, or winter. I'm trying to think of some of the other average vehicle expenses. If you have a car payment, that will generally be the same across. And what you might have to do is take on a piece of paper and write down, okay, I'm going to have $300 in car expenses, $100 in insurance, and then my gasoline is going to be the only thing that varies each month. And so, what you can do down here is say, okay, up there in car delivery, I'll put the 300 and the 100, and that'll make 400 every month. And then down here in 18, I'll come and write gasoline, and some months it'll be 50, some months it'll be 75. I'm going to do a lot of deliveries in March, and then you can come and really estimate for that one specific item that's going to vary, but the other expenses that are fairly similar each month, like the car payment and the insurance, you can just have those up there. And excuse me, let me go back and just copy across, and makes it much easier in doing your estimation. And you'll notice as I'm going along, it's tallying the total at the bottom of each section. So for expenses, it's tallying as I add things across. And then it's also doing the calculations down here, adding the other operating costs and the expenses for a total cash out, and then subtracting from my cash on hand, adding the cash receipts so we get total cash available, and it's subtracting the total cash out from the total cash available to get a number down here. And so that's why you're seeing. Now, I didn't plan this, but actually what is happening down here is we have gone negative in certain of these columns, and that's because we're continuing to spend money, but we haven't been adding our sales. And generally it's not going to look like this. You're not going to have 2 months of sales and then no sales anymore. But what generally happens is you may have a certain level of spending for the sales that you have, but then all of a sudden your sales drop, or you have to increase your spending, and you actually start spending more and spending more cash than you actually take in. And eventually it may get to a point where you don't have the reserves anymore, and you actually have now spent more money than you even have to spend. And why we do the cash flow projections is that allows us to plan for times like that. It's better to take a look at planning for it now and saying, okay, in July of this year, I'm probably going to go negative in cash. What should I do? Should I take out a loan? Should I reduce expenses now? Should I try to find a way to increase my sales? Is there a way that I can delay some costs? Maybe I get some credit from a supplier. There's a number of different things that you can do to try to keep from going negative, but at least seeing it on a sheet like this, that will give you the chance to be able to plan for it into the future. And I know you can't be 100% accurate, but you can at least say, okay, even if you're getting close, maybe you don't go negative, but you're getting near zero, or you're getting down into less than $100. Okay, well, maybe that's time to say, okay, that's a little bit too close to cut it. I'm going to try to find ways to make sure that I don't go negative. So, just recapping just real quickly, we start with cash on hand each month. We add in our cash receipts, so these 4 rows become total cash receipts, and then we add our cash on hand to our total cash receipts for our total cash available. Then we have our expenses each month, and then we add our expenses down here. This is the subtotal for the expenses. Then we have our other operating costs, so loan payments, buying anything that you don't immediately expense, you would have to depreciate, reserve and escrow, so these are things that aren't an expense, or even if you have an owner's draw. In a sole proprietorship, if you take money out of the business, that's not technically an expense. So any of those things, you would include those down here. We would add the expenses with the other operating costs and get to a total cash out, and then we would subtract our total cash available, C, from our ending balance, or from our total cash out, F, and that gives us our ending balance. And what do we do with our ending balance? We take it from the bottom and we move it to the top, and that becomes our cash on hand that we start with for the next month. So I hope this was a good explanation for you to at least get you started in doing the cash flow budget. And I think the really true way to master the cash flow budget is to start practicing and getting involved with practicing and entering your numbers and making your assumptions.